Good morning, good afternoon, good evening. You're watching Zakatech FX. Anywhere you're watching this video, thank you so much and God bless you. And I'm going to do a little recap before we talk about this reversal pattern, which is the wedge. So in my channel, in my YouTube channel, and in my Facebook, also on TikTok, I've I've uploaded some free lectures. People that want to learn about forex and get themselves for beginners. For beginners that want to learn about forex trading, you want to have a strategy, you want to use in trade, and so many other things. Can follow my channel, subscribe to my channel because I'll be dropping a lot of things concerning forex trading and how to make money online too, crypto, and also many other things. The link is below this video. Anywhere you're watching this video, kindly subscribe. If it's on Facebook, boom, subscribe. If it's on YouTube, go ahead. If it's on TikTok, kindly follow. All right, we've talked about in my previous lectures, we talked about support and resistance. We also talked about trend line, candlestick patterns, and different kind of candlestick patterns. We have we also talked about patterns, price patterns. So in price pattern, we have continuation pattern, we have neutral pattern, and we have reversal pattern. So I've done neutral pattern and also explained to you guys what a continuation pattern is. You can check that on my YouTube channel. There's a playlist there. You can watch the video, understand what continuation pattern. Whenever you see it on a chart, you will be able to understand what it's all about. So today we'll talk about the wedge, which is one part of what reversal pattern. So in reversal pattern, we have wedge, we have head and shoulder, we have double top and double bottom, which we like trading on mostly on our actual chart. So the wedge. Now, if you talk about the wedge, we like trading this wedge on 15 minutes time frame. Whenever we get a trigger on a high time frame like 4 hours or 1 hour, we scale down to 15 minutes time frame on our charts to find this position, to find this pattern, so we can be able to take a reversal with it and ride with the price. All right, talk about the wedge. This wedge, you have bullish wedge, you have bearish wedge. So this bullish wedge and bearish wedge all likely appears whenever we have a decent reversal. That's whenever a decent reversal is about to happen. That is when you see this kind of wedge pattern. Basically on the lower, you can see different kind of patterns on 15 minutes whenever we have a price reversal on a higher time frame, a candle reversal on a higher time frame like 1 hour or 4 hours. You can see this reversal pattern on the lower time frame like 15 minutes. It shows it's clear, right? So when you talk about the bullish wedge, price is trending what? Lower. So at the bottom of the trend, the last couple of lows are shallow. Like this couple of lows is here are shallow. This couple of support areas are very shallow. Price finding it difficult to do what? To break out on this zone. Just take out the liquidity from this zone and go back up. Take out the liquidity of this zone and go back up. Take out the liquidity of this zone and go back up. Almost we're trying to bottom out these lows. So the first low is followed by a slightly low. This first low is followed by slightly low. This one is also followed by a slightly low here. So we have a slight low here, and the highs are not shallow. When you take a look at this high, it's not shallow at all. It maintains that high. This high is higher than this swing high this high is higher than this one, and we may have more than 2 or 3 swing highs here, and these lows here are shallow, right? Now, the same thing applies to the bearish wedge. So all these things, they keep falling. All these kind of lows and all these kind of highs, they keep forming a dramatically low patterns, right? So the opposite of this bullish is bearish. So that's why you can see a high, its resistance area are shallowing upwards because they can't be able to take out this high. So they find it difficult to take out this high. This high is finding difficult to take out this high. This one finding difficult to take out this high. But the lows are maintaining its upward movement. But the highs are shallowing upward, right? So here in bullish wedge, market drops down. Anytime you're looking for a bullish movement, a bullish pattern on an actual chart, the price must be coming downward. I repeat, anytime you're looking for a bullish wedge pattern, the price must be downward. So when a market drops downward on maybe on 4 hours or 1 hour, or you see that on 15 minutes, then we'll have a support zone where market tends to form a support, goes high, form a high, then this high is higher than this high, they drop down again. Find it difficult to take out this liquidity here. So you may use a spike here, take out the liquidity of this zone, take out stops, take out stop loss, take out pending orders on this zone, trigger those pending orders, and pull back again. When it pulls back, there are some orders on this zone, but you couldn't take those orders. We have this. That means this higher is higher than this one. It forms another high resistance area, drops back down again, and this zone again. You find it difficult to take out these zones because it's very, very shallow. So your trend line, you can use your trend line tools to dictate these lows here. If you know how to use your trend line tools, you can watch the video in my channel where I talked about trend line tools, right? So when this bullish wedge is forming, the lows are very shallow, but the highs are dramatically, doing its thing, right? Now, whenever the market tends to break out on this zone, whenever the candle tends to break out on this previous high you see here and closes above, we may have a retest before the market pulls up. That's a bullish wedge. And how do you dictate that? Use your trend line tools to pick up the 2 or 3 highs and pick up the shallow lows, which is the support zones, which market find it difficult to take out. Now, coming to bullish, the highs, that is the resistance zone, are shallowing upward, but the support zone are doing its things. That is the price is doing its normal thing, but they find it difficult to take out the highs. So the liquidity here, the price here, markets try to trigger its stops. Some people sold from this area, some people bought from this area, some people sold and set stop loss above this area. Now what happens? Market will go back, trigger those stop loss, trigger those pending orders, and trigger those things that is being set atop this area, come back downwards again, went up again to say tell those people that the price is still trying to break out, trigger those another people will enter this zone. It triggers another stop loss, triggers a lot of things because the lows are becoming shallow, triggers all those things. What happens? The markets will drag all of them downward trends, and they will be in a negative form, right? So that is that about a bullish and a bearish wedge. So let's see how you can be able to trade this bullish wedge on and how the formation for it to trade a bullish wedge so you can be able to make profits. Now take a look at formation in a traditional manner, how you can trade a bullish or a bearish wedge. So if you want to go for a bullish wedge, if you draw your trend line, extrapolate the trend line when picking up the highs and when picking up the lows. Now use your crosshair to measure. Crosshair is in your MT4 platform. You can watch the video on my channel how you can use MT4 platform and know what crosshair is, how you can use it to measure pips and whatever you want to measure on your chart, on your price chart. Now when you take this high here and the low of the big low, when the market where the market starts to bounce, right? If from here to this zone is 50 pips, now when the market tends to break out of this zone and move upward, that is a bullish wedge. What happens? You measure that 50 pips. Your traditional target should be what? 50 pips. So if you enter that trade, your stop loss should be below and your take profit should be higher. So it may be 3-to-1 ratio or 2-to-1 ratio. So from here to here is double from here to here. So this is a typical example of how you can traditionally trade a wedge on your actual chart. The same thing applicable to bearish wedge. Now if you talk about bearish wedge, the market will come upward. The market will be a bullish market. Now whenever a bearish wedge wants to happen, you use your trend line to pick up the shallowing highs, shallowing resistance area, and pick up a support zone below it. Now, where the trend line touched to where the support trend line touched, you measure it. So if you're entering that trade, you are picking up 2-to-1 ratio or 3-to-1 ratio or 4-to-1 ratio, where your stop loss will be below the last high, then market tends to do what? Drop down and hit your take profit. So if this is 50 pips, from the first place where the market tend to form this wedge, then traditional target should be 50 pips. You can also target 45 pips and it will set your take profit on the previous low or a previous market swing, right? So that is that on how you can traditionally trade a wedge on an actual chart. So let's take a look at it on an actual chart and see how it works. Now, this is what we call a bearish wedge formation on a real chart. Now, if you take a look, market was coming downward, then forms a low here, a swing high, low, higher low, right? Now, what happens here? This the last low. Now, if you measure this area, as I said previously, if you measure from this zone we extrapolate this trend line on this zone and measure it from here to here, you can see the market did that same thing from here to here. Now the market went up, hit this high, comes down, the low is doing its thing, but the high find it difficult to do what? To take out this liquidity. What happens here? There's a stop here, there's a stop loss above this area, a few pips above this area. What happens? Markets came up again, picked and collected all the stops, all the pending orders, everything set to this zone, and what came down to this zone, closed below this line, closed below this trend line. What happens? Markets dramatically broke out and what did a long pips, right? So this is a bearish wedge on an actual chart. Some call it rising wedge, some call it falling wedge, and different kind of wedge patterns you can see on names on a chart, right? So let's talk about the bullish wedge. Now here's the bullish wedge. Market is coming downward. Now what happens? Forms a high, drops down, forms another high, drops down. What happens again? Markets broke out to this area and pushed up. Then how did this happen? We have a low, we have a high, we have a low. The low is trying to narrow down. The low is trying to narrow down, trying to form that low. What happens? It took out the liquidity of this zone. What happens? And came back, broke out this zone and what? Went upward and broke upward and moved upward trend. So that is that about bullish and bearish wedge. So the bullish wedge, market is coming upward, and market is coming upward, the bullish wedge. Then the bearish wedge, market is coming upward, the bullish wedge, market is coming downward. Sorry guys, sorry about that. So that is that about bullish and bearish wedge formation on reversal pattern. Thank you guys and God bless you. Don't forget to subscribe to my channel. Don't forget to like this video, give me thumbs up, comment, and I'm open for corrections. And also you can like my video, follow me on Facebook, and follow me on Twitter. You can follow me on social media platform where we share different kind of things. I'm into online and offline entrepreneurship, business, crypto, and whatever so call it. So thank you guys and God bless you. Bye for now. Peace.